And yeah, so John gave a great overview on CBDC, and afterwards we will have the panel chaired by Martin, where we will dig into different problems and questions. So I will give you just now in between the digital euro perspective, and we'll do two things: justify again digital euro, provide the ECB version of justifying CBDC, and then touch upon some issues that are being discussed, like financial stability and monetary policy implications. So, yeah, very briefly, the justification, on one slide of digital euro is that payments become more and more digital. Here are some statistics. There's even new data now which goes further than this. So cash payment every year are losing market share and payment. Of course, in e-commerce, you don't pay with cash anyway. E-commerce is more and more important. And also at the point of sale, even in Germany, cash is being gradually retiring. Example, at Rewe the other day in Frankfurt, I noticed, there was almost all the cashiers had disappeared, the human cashiers. Everybody has to use now self-serving payment desks, and those accept only electronic payments. No, so in theory you could say you could use cash, but if the queue is very long for the one single human cashier, then you don't want to do that. So the trend is there. Although Germany is not really at the forefront of digitalization payments, you see the trend really everywhere. And on top we have in Europe the phenomenon that card payments dominate electronic payments, and they are mainly, and with a growing market share, dominated by two international companies. So also the European, let's say, governance autonomy aspect is an issue. And the idea of digital euro is just maintaining, preserving a role of central bank money, preserving the coexistence of private money and central bank money that we assumed to make sense over the last decades or even longer. So here again, the same, a bit structured in, I think, 5 or 6 points in total. So why? First, monetary anchor. That's a bit of an abstract argument, but I think it still makes sense, no? Commercial bank money, we don't live in the time of gold standard, no? So in the gold standard, you could say a commercial bank liability is also somehow convertible into gold, but we live in a paper standard. So what is commercial bank money? What is private money? It's a convertibility promise into central bank money, no? So really, what holds the system together? Convertibility into central bank money. If central bank money would disappear completely, then that becomes a pretty abstract anchoring, no? So in a certain way, maintaining a form of central bank money for everyone allows everyone to be part of the anchoring of those private forms of money, which are nothing else than convertibility promises into central bank money. Second, payments is an essential societal function. So payments enable modern society based on the division of labor. No, we pay all the time. We couldn't survive any longer without division of labor, relying on others. So payments is not just one function in society, it is the function of modern society. And it doesn't seem exaggerated to maintain also a publicly controlled instrument of payment, no, as that is the central function of modern society. Choice, it's an additional option for citizens designed from a public good perspective, not from a commercial perspective, which also limits the potential abuse of market power by dominant private firms. Money is really something, per definition about network effects. Now you use money because others accept it. So it's driven by network effects. So therefore, logically, the winner, the dominating firms will have a very high market share. So you always observe a high degree of concentration, currently, as mentioned, you observe this trend of the international card schemes to become more and more dominant. Or also in the e-commerce, you have few dominant firms. No, it's not a granular market. So of course, private firms have market power, and they are supposed to be profitable for their shareholders and to abuse to the extent possible the market power. And that's in a certain way the whole reason why also central banks come to existence at the center of the payment system, because it is a public good. It is dominated by strong network effects, and the central party in that must not abuse market power, must be a public player in a certain way. And let's say by preserving the coexistence between central bank money and private money, you limit also the potential abuse of market power by private firms. Then, a way to put it also simply, it's just a natural modernization of central bank money while preserving banknotes. Of course, as central bank, we don't want to get rid of banknotes. That would be absurd, because banknotes is really the exclusive baby of central banks. No, we would be self-defeating if we would say, let's get rid. It's the basis of our profitability. It's the basis of the signage income we can pay to the government. So why would we be against the cash? Certainly not. But, payment habits change and technology has changed. So there is a clear trend. And one could say, why should the central bank be the only party staying exclusively, let me put it provocatively, with 17th century technology? Everywhere, commercial bank money 70 years ago, let's say before any means of electronic payment, 70 years or a bit less, appeared. You also paid with checks, with paper. So obviously, checks are inefficient. So that doesn't exist any longer, really, not much at least. So, it's very strange to argue central banks should be the only one sticking only to paper for the rest of the times if everybody moves on. So why should technology determine the monetary architecture and one party staying behind in technology, being the natural way to exit this party? And then those two arguments, go beyond in a certain way. The previous arguments, are sort of, purely conservative arguments, if you want to put it this way. So it's about preserving the role of central bank money. So CBDC, digital euro, as we see it, is not a revolution. It's the opposite. It's a conservative move to preserve central bank money and its roles. And those 2 points go a bit beyond, and they are specific maybe to Europe. So that would be a pan-European and universal electronic means of payment for European citizens, and that no other means of electronic payment offers yet, because the digital euro would benefit like cash from legal tender status, and there's work by the co-legislator to make this legal tender status both for cash and then for digital euro more effective. And when you pay, when you have a means of payment, and that's also a strong selling proposition, for CBDC, for digital euro, that you can use it everywhere. Every merchant who accepts any electronic means of payment will have to accept digital euro. Yeah, that creates attractiveness for users and creates scale. And then the other point is international sovereignty, strategic independence of Europe in view of the not so favorable geopolitical developments, and again the important role of payments in society to really ensure we have a European offer also. Of course, we support private offers, we support EPI, those types of initiatives. We believe there's ample space for private and public solutions, governed by Europeans. We would be crazy, if we worry about overpopulating the payment market with European solutions, if the reality is we see a continuous, decline of the market share of European solutions. So it's a huge market, and we should not worry about being successful private and public solutions at the same time. So then, yeah, there's has been a lot of debate, and I would say now too much debate on the economic risks of digital euro. So one is the deposit outflows from banks now. So it's a bit worrying that digital euro will be so successful that a lot of deposits will migrate from banks into digital euro. And yeah, that has been, heavily discussed, I would say, and has been then taken up in the design of digital euro as it has already been announced. And that design includes no remuneration, holding limits, then something called reverse waterfall functionality, which is about the fact that you don't need to warehouse digital euro on your wallet. There is a function that you can activate where you can make a payment, even you buy something for 500 euro, you have 100 euro on your digital euro wallet, 400 euro will be sourced like an instant direct debit from your commercial bank account. A bit like when you pay with PayPal, you don't need to warehouse positions though on your PayPal wallet. PayPal gives you a credit, it's settled maybe a day later. Here the idea would be instant payment technology. It would be sourced immediately. We would not provide credit, But still that would allow, people to pay with digital euro without warehousing, bringing down the amounts held in wallets. And then there will be no holdings for merchants and no holdings for, non-natural persons, basically. So all this will lead to a pretty low volume of digital euro. And here, this is a flow of funds chart, about how digital euro or CBDC in general affects the banking system and the central bank balance sheet. And the blue, let's start with the blue flow of funds. That's called DIG here for digitalization. So even if you have no CBDC, what we have seen in countries like Sweden, the amount of banknotes in circulation has dropped by more than 50% over the last, say, 20 years, because people only pay digitally. So this drop of banknotes in circulation benefits deposits with banks. Yeah, people bring back their banknotes, and that's what the blue flow here is indicating. So it's a substitution. Banks can reduce central bank credit because they get those inflows, and the central bank balance sheet shrinks. Yeah, and that's important in that context because digital euro again or CBDC is a conservative reaction to the declining role of central bank money. So the starting point, why at all CBDC is considered, is a flow of fund effect which benefits bank balance sheets and goes at the expense of the length of the central bank balance sheet. Which per se would be fine. It's not part of the justifications that I gave you for digital euro, that we want to preserve a long balance sheet. It's not a justification, but it's an important context if you discuss the negative effects of digital euro on bank funding, because digital euro is not, an exogenous crazy idea by central bankers. It's a reaction to the declining use of banknotes. And in the euro area, you had indeed not yet a development like in Sweden. Banknotes had a fantastic run in the low interest rate environment because banknotes had no opportunity costs. Since 2021, I believe we have a decline of the real amount of banknotes in circulation. But just to say, this effect, is a starting point. And then if you introduce CBDC can be sourced either from deposits with banks or from returning banknotes. People, if they substitute banknotes with CBDC, that's a green flow of funds. If they substitute bank deposits, it's a red flow of funds, CBDC2. And the net effect on bank funding is basically minus DIG plus CBDC 2. So what is important, we believe in the way digital euro is being designed, this net effect is, there's no reason to believe that the net effect will be negative for banks. I think we have designed digital euro in a very prudent manner that I personally, it's my personal opinion, believe that the relative role of central bank money in terms of stocks will be lower in 20 years than today, even if we issue digital euro, yeah? The other question, is, do we crowd out banks from a payment perspective? So is there a risk that we are too successful, no? So, John emphasized that the projects so far were not so, successful, but some people may also worry it's too successful. So I personally believe we should be ambitious. We should take John's message seriously and be ambitious in deploying it as means of payment. And okay, the question is, can we target, a certain market share? Now, banknotes and digital payments coexist, relatively stable over time. Okay, cash goes down in its market share. But if we now enter this habitat of electronic payments, the two become closer substitutes. And the question is there a stable coexistence between central bank money and private money in retail payments? Or are we either, crowding out everybody or the opposite? And that's an interesting question. You could say we should seek for some distinguishability. We should cover a bit different use cases, have different features. We will have offline payments, for example, that don't exist in private solutions. So I would say interesting question. I think overall we must be more worried about that it's not so easy to deploy a digital euro, so we should be aggressive. We should not worry, in my view, too early about being too successful. And then maybe as a reflection that coexistence is possible. Visa and MasterCard are very close substitutes now, but they, and you could say network effects, one should win over the other, but it's, a relatively stable equilibrium also. So maybe even if you have two solutions which are relatively similar, you can end up in a stable equilibrium. Okay, future of retail payment, that's my last point. So as I tried to argue, what we do with digital euro is a conservative move, preserving central bank money, not changing the monetary architecture that we had so far. What has worked well over the last decades is preserved. But I have here, a few alternative options, and I call them 3 radical options and 1 extremely conservative option. The extremely conservative option is to say CBDC, is a wild idea. We should not do that. Truly conservative is let's fight for banknotes to be used. So we could try, to do everything that banknotes continue to be used. Is it possible? I don't know. If people, get used, if Rewe no longer offers, a way to pay with cash in practice, we will end up all paying electronically. So I'm not sure this is really a good solution. It's very backward looking. It, for some reasons, would assume that central banks are married to cash while everybody else is not. So I would say probably excessively conservative. That's why we prefer conservative option 1. Then here are the 3 radical solutions, which are all in red, meaning, that's not the solutions we as a central bank find great either. So cashless society, the United Arab Emirates, for example, have this policy, let's move to a cashless society where we have CBDC and private electronic money solutions coexisting. Advantage, you could say, cost saving. You don't have to maintain the cash infrastructure on top of CBDC. And disadvantage is loss of unique features of cash, privacy, inclusion, and resilience against IT failures. No? Second radical option is sovereign money. You have some initiatives. It's, if you want, a kind of left political left idea to say commercial bank money is bad. Banks get regularly bailed out by taxpayer money. They should not be allowed to issue sight deposits, and let's go for sovereign money. Only the central bank can issue money. And here we would say disadvantage, loss of synergy. I mean, the business model of banking is issuing sight deposits and granting credit, creating commercial bank money, and we believe into that. And that also, the growing central bank balance sheet, if we are the only issuers of money and the 10 trillion in the euro area, which are now sight deposits, all become central bank deposits, then we get a really long balance sheet and we centralize credit provision in a certain way. We take over a part of the bank balance sheet, so we don't like that either. And the third radical option is just to give up on central bank money, accept that banknotes disappear, and I mean, disadvantage is just the opposite of the reasons why to issue CBDC. And that's a graphical presentation. That's my last slide. And what is here, I mean, the C1 is our green solution, the conservative solution one, where we conserve the role of central bank money by issuing a digital euro in addition to banknotes. And we are more or less in the middle of those triangles. Sorry, we would be in the middle of the triangles. Where we are now is the yellow, the zero, and the zero is moving, no? So the triangle on the left is on the bottom. In both cases, on the bottom is central bank money, on the top is commercial bank money, and in one case, left is central bank money split into digital euro banknotes, and on the right, central bank money is one, but private money is split into European and global payment instruments groups. So if you look at the central bank money, the triangle on the left, the point is that from where we are now, if we do nothing, we would move gradually to a purely commercial bank money-based solution, radical solution number 3. And if you take the right triangle, the problem is we are moving on top to more and more dominance of global groups' payment instruments. When you pay with at Rewe electronically, you don't only pay, with a card, an international card scheme, but on top you use Apple Pay. So, even several companies with significant market power. And if we would do nothing, move to R3, we would also move to this right corner. So a lot of market power, and on top, not European firms. So that's all. Thank you.